Hello traders. So this particular session I'm going to do here is not specifically an option strat session is maybe the best way of saying it. In other words, I'm not going to be really using OptionStrat in this particular session, but this session is going to be about reading the market in general, which I think is critical to any trader. It's something that you need to know how to do. And part of what OptionStrat has asked me to do is to help educate traders specifically on their software, but also in this case, I think it warrants taking a look at our markets in general and just one take that a professional trader might have as to how they're reading the current market conditions. Again, this is my personal take. This is not a recommendation of any type. This is not trading advice. This is just how one take on how a trader might look at the market and might read the markets in our current market conditions. So with that, let me get over to some charts and we'll take it from here. Okay, so let's take a look at our market. So this is a chart of the SPX. These are daily bars. And back here is where we broke out. So I want to talk a little bit about technical analysis. And this is just big picture technical analysis. This is not getting into the nitty-gritty, if you will. But if we look at a big picture chart, so we're making, new highs back here, new highs for the year for that period of time. In fact, they may have even been total new highs. I'm not 100% certain. And then we sold off, rallied back up about to the same area. Again, technical analysis is not extremely precise. It works off of ranges. So we get back up into this area and the psychology is, ooh, we've made new highs in the market. So people start selling and taking profits from anything they might have bought down in here, down in here. Now, these are what are called the shorter term traders, or sometimes they call them in the market the weak hands, the people that are looking specifically for short-term pops. So they're looking to buy the dips, sell the rallies. And so that's kind of what's happening here. We rallied a little higher, then those people started selling, and then somewhere down in here, they start buying again. Now, I want you to notice this trend line right here. We're going to talk about that again in a minute. Then they start buying, and the market rallies up to its prior highs. People start looking at this and saying, should I maybe move out of my position that I had built up in Apple, Microsoft, Amazon, Johnson & Johnson, whatever, and they start to sell out. And then, as they sell out, the market sells off again, but it doesn't sell off quite as much this time. Rallies to the same point, sells off, rallies to the same point, sells off. But you notice each of these sell-offs is getting a little bit lighter. The sell-offs aren't quite as deep. Finally, we punch through, pull back to that support line, and then these people that were looking to buy now are saying, I see what's called a breakout. And with that breakout, they now think, it's off to the races, and many times it is. So when we get a pullback to that line that had been resistance, that line now is support. And again, when I say that line, I'm talking that general range is now support, so people start buying. And once we break out above that prior day's high, things really, really take off. Well, then you get a run, and what many people do is they measure this run from this breakout point to this peak. And usually it will be very, very similar in distance to the last rally. So if you had a rally here from, call it 38.11 up to 4170, so 38.11 to 4170, so that's like 250 points. So then our breakout here, 4180 to 4600, that's a little more. So that was a little, I was looking to here. So 4440, and we broke out at, call it 4200, so about 250 points. And then we pulled back, and then we had another run here that was about equal to this run. So those are what's called waves, and the market will largely kind of move in waves, which is, I'm not a huge person on Fibonacci. I've read a few books on it and stuff, and I understand what it's doing, but I'm not I'm not here to try to teach people Fibonacci. I don't know it well enough. But I do know that, when you get pullbacks, again, we tend to work in waves. And now we sold off, we rallied up, but we made a lower high. We didn't make a lower low here yet, so we technically weren't in a downtrend, a short-term downtrend. But then we made another lower high, but we still hadn't made a lower low yet. So we're technically at that point still in an uptrend. But then we finally came through these lows a few days ago. We dropped through these two lows. So now we've made 1, 2, 3 consecutive lower highs. And we made here a lower low. And now we've made a second lower low, which kind of confirms that we're in a temporary downtrend. Now, in the big picture, that's what I want. It's important to understand there's two ways of looking at these markets. In the short term, we are currently in a downtrend. In the long term, let me zoom out on this a little bit, or shrink this up a little bit. Let's see. We are, at this point, still in a long-term uptrend. And you can see this uptrend line is still intact at this point. So, long-term, still in an uptrend. In fact, you can even call it a channel. If you were to take this and duplicate this line, and then put that up to here, you essentially see that we have been in a large uptrending channel. So what I want people to realize and understand here is that the reason I've kept light in my positions is that I am recognizing that I'm in a short-term downtrend here, so I don't want to get too full on particularly a butterfly style trade, because when the market sells off, volatility goes up. And in fact, we'll take a look at volatility here in a second, but our volatility, or VIX, is up to almost 19 now, which is a pretty big move from where it was. And that hurts butterflies. That transition from low volatility to high volatility has a negative impact on butterfly trades. So I purposely had been staying lighter in my trading, in class trading, etc. Now what I need to be looking at is, okay, volatility is up. This blue line is implied volatility. The purple line is historical volatility. When our implied volatility is greater than the historical norm of volatility, that's a good time to put on butterflies. You can usually buy them cheaper, but at the same time, you want to be a little careful to make sure that this downtrend, if it does not accelerate quickly to the downside, because if that happens, anything you put on here, even though volatility is relatively high right now at 19, that doesn't mean it can't go to 40 in a day or two, which would really be disastrous. So the goal here is to try to look at volatility and try to determine when volatility might start to ease off, might start to subside a little bit. So how can we do that? How might we have a clue when that might happen? Well, for me, one of the biggest things to look at is, let's look at where we think the market might stabilize, or where we think the market might turn a little bit. And there's a couple clues here. One, we're pulling right back to this trend line right now. So this trend line is at roughly the 4250 range. So, that's another 50 points down from where we are. Let's see, is it 50 points? No, it's about another 15 points down from where we are right now. But again, we're not talking a real precise number, because many people will draw these trend lines on their charts in different ways. And so it's a general range down here around the 4250 down to probably 4200 range. We also have all this former resistance that now will become support. So this area, again, talking a range here from 4175 to probably 4225. I would view as support if we get down to there. And then there's a third thing that is, in my opinion, support. This blue line here is the 200-day simple moving average. Now, the 200-day simple moving average is something that for many, many years has been used by institutions. It's kind of a back up the truck sort of timing that when the markets get down to that 200-day simple moving average, that's often a time that institutions start to look at buying and buying in some significant size. That before we had all of the increasing complexity of Fibonacci's and Elliott waves and all the different ways people can measure the markets, this was one of the simplest ways that many traders, many long-term investors would use to measure the market and when might be a good time to buy. Are you picking a bottom here? Probably not picking a bottom, but at the same time is at a point at which investors could define easily and say, you know what, when it gets back to here, I need to start looking at, buying some more assets. So all of these things kind of congregate right in this 4150. Thinkorswim wants to access my microphone. Don't know why that would be. But all of those things start to congregate right in this general range. So that gives me a sense that we might start to slow down and or stabilize. Now, I also want to look one more thing. Let's look at the VIX, the chart of the VIX. So we can chart the volatility index. So this is the VIX. It had been very low here, down around 13. And now it has spiked up almost to the 20 mark. Now, VIX tends to be what we call mean reverting. What that means is that you can see that there's kind of a confluence right in here around this 16 range if we come on across. And, previously back in COVID times, that 16 range acted as support. And then when COVID and all the fear surrounding COVID finally settled, we finally broke down through that 16. We rallied a few times, meaning there was fear in the markets here. And then things really quieted down and settled down. And when this happens, that's when the market starts to take off and move higher. Because there isn't fear in the market, people are out there buying. And then we rallied, we had some fear come in here around the 18 mark, and then that fear subsided over the next week or two, and now we've rallied again. Fear is back in the market at this point. So a couple things can happen. One, and when I say fear subsides, really what happens with humans is we adapt to our new reality, and then that fear starts to go away. And COVID's a perfect example of this. Some of you have maybe heard me say this before, but back in the early days of COVID, volatility just spiked horrendously. I don't know if I can go back to that or that far or not. Let's see, that was back in this is December of 22, so it was before that. So probably in this general area here is when volatility really spiked up into that 38, 40 range. Here, we had another spike up into that 38, 40 range. And as we were going through COVID, there were huge run-ups and drop-offs. And again, in recent times, as our markets have rallied to new highs, volatility has been very low. And so now it has rallied back to this point. And the question is, if we break through that various support areas that I just had shown you, the 200-day moving average, we break down below that upline, below that support line, if you will. If we break down below what had been prior support, if all that falls away in the next week or two, then we're in a long-term downtrend. But again, right now, if I put odds on this, I'm saying that we're better than 50% that we will be likely stabilizing or bouncing off of this range. And even though the market's been scary the last couple of weeks, the whole debt ceiling thing has been scary, I guess my point to the way that these subside is that people adapt to it, even in COVID, even though, COVID was scary, very scary at the start, and volatility spiked way up. But then as we got used to COVID, as we got used to the concept of, well, okay, I guess I can wipe down my groceries after they're delivered. I can order out food and spray the bag before I bring it into the house. I can watch a lot of Netflix and not go out to eat or go to a bar. After our mind wraps around the new normal, the fear starts to subside, even though that original event is still there. And so the same could potentially happen here with this whole debt ceiling issue is even if the debt ceiling does not get resolved by this week and we go into the situation of not paying our service workers, not paying our government employees, not paying our military, which to me is deplorable, but another subject. If we go into that scenario, volatility could spike a little bit. But if that's all that really happens, I say if that's all, obviously those are major things. If that's all that really happens, after a week or two, people will start to get used to it. I hate to say that, but start to get used to it, and volatility will likely subside. So the whole point to this thing is I wanted people to understand what I'm looking at in the market so that hopefully it helps out you and gives you kind of a framework for what a professional trader might look at. And basically to say that now's a time when I start to size my trades up a little bit. Now, again, I could be wrong, but when I'm putting on these new trades, I'm putting them on with enough width in the butterfly trade that, if the market drops down to some of these lower points that I might be expecting, if the market drops down to, 4150, my trade isn't blown out. I might have to adjust it. I might have to skew that trade a little bit more and adjust it. But that unless I get a total breakdown and we end up running all the way down here to the 4,000 mark or so, my trade can withstand some movement here. And also note that when volatility is up, these trades, these butterfly style trades, get much, much less expensive to get into. You get a much better reward to risk ratio. Again, I know this was long. Some of you probably don't really care, but I think this is really important information, and it's good information to share now that there is this fear coming into the market, now that we do have a political event that's driving some of that fear, and to see how I and other traders will often think about these events. So thank you so much for staying around for the duration of this. Hopefully you found it useful. Take care.